Hey everybody, welcome to our YouTube channel. My name is Glenn Tompkins, Senior Instructor here at VectorVest, and I love bringing these videos to you. Today's video is entitled, What Should the Fed Do? I'm going to take you through a process of helping you to decide in your own minds what you think the Fed should do. But keep in mind, folks, it's not what we think. The Fed's going to do what the Fed's going to do, and you can't fight the Fed. First of all, if you're brand new to the channel, I invite you right now, hit that subscribe button, hit that bell icon so that you'll be alerted to when new videos or live streams become available to you. If you like the commentary, folks, I implore you, please hit that like button. And most of all, if you really like the content, share it on your social circles so that other people out there in the investing world can see what we're doing here at VectorVest and how we do the work. You reap the rewards. We lay it out for you guys to make your own decisions. All right, so this topic, what should the Fed do? It's probably a topic that's being beaten to death all over the place, but I'm going to take a different spin on it. I'm going to look at where we were, where we are now, and what we should think about, and I'm going to show you a specific way to use the VectorVest system to help you to make a better decision as well. So you need to stick with me to the end of this video so that I can help you to answer that question. What should the Fed do? Well, let's talk about where this all started. Inflation. Inflation comes from rising prices, all right? Food and fuel are the most painful. When you go to fill up your car, when you go to buy groceries, that's where it's more stringent upon us. This is where it hurts us the most. And the demand rises while supply decreases. We had a problem with our supply chain issues, and that helped to drive prices higher as well because the supply wasn't there. On inflation, though, we're at 40-year highs, but it seems to have topped. If you haven't checked out the video that I did about has inflation peaked, check out that video. I invite you to do that now. What happened? Mamma mia, what happened? We had a global event. We had a pandemic. Pandemic hit. Businesses were shut down. People were laid off, and unemployment rose dramatically. Fear of contracting COVID. A lot of people did not want to go back to work. We had mandates. All of these things stopped people from doing business and stop businesses from making money. It sent the economy into a downward spiral. How did we respond? Well, we're resilient as a country. We're going to do the things to keep our people in play. The economy was stimulated by federal assistance. And we had things like the CARES Act, the Consolidated Appropriations Act, the American Reserve Plan. There was a lot of things that were put out there to help to stimulate the economy so that people could get out there and spend more money. Also, the Fed lowered the interest rates to give some stimulation to the economy, and it caused a recovery. All right. What was the result? Money was spent back into the economy. We had a robust economy. We had money to spend. So what? Prices increases. You got the money to spend. People are going to raise their prices because you got the money to spend. Prices increases and inflation starts to rise. Inflation rises, wages are increased. That's a great thing. So if you want to keep me as an employee and inflation is going up, you're going to have to pay me more money. But let me tell you a story about rising wages. Wages increased, prices increased, more adds to inflation. Raises rose over the last year by 5.5%, but prices rose by 8.6%. So even though raises or wages rose, they weren't keeping up with inflation. Inflation is an issue. This year, now we're spending $350 more on goods and services than we did last year. That is inflation. So we stimulated the economy. We put the money back in the economy. The people were spending the money, drove the market higher. Guess what? The product of that is going to be inflation. It's going to happen. So from that, what was the Fed's next moves? Well, we hit the 40-year highs on inflation. Then he turned around and said, all right, we're going to start raising inflations, but it was a rapid, aggressive move to raise the interest rates. That was his main tool on the books to be able to go effectively after inflation. Now, higher rates, though, costs more money to borrow money, and that's what major companies do. It's part of doing work. They borrow money to put into research and development and a lot of different things. It's a part of doing business. But as you raise the interest rates and that happens, it helps to tighten the economy. And that's what the Fed wanted to do, to slow down the economy. but the increases were the strongest, steepest increases over the last 40 years. I look back at several other opportunities where the Fed had to raise interest rates. They were nowhere near as steep as what we're going through right now. And that's affecting people in an adverse way and stating that the Fed's got to turn this around. Does it really have to? The Fed says inflation was a number one priority, that they're going to do whatever it takes to go after it. But the problem was, in regards to this, the Fed called inflation transitory. They'll never downlive that. And they even walked back and said, well, sorry, that wasn't the case. It is, and they were late to the party. But he's also stated that his policy would cause the economy some pain. The issue is that the pain that it's causing, people are cringing at it right now. Is it enough pain? Personally, that's part of what we got to do. We got to go through the pain. And you know, every time I say that to myself, no one wants to be in the hot seat to be the person that caused the pain. You know who did though? Volcker did. Volcker raised interest rates and raised them and put the economy, but it was needed. I think that it's also needed this time, but a lot of people are like, yo, I don't want to have that happen. I don't want to go through all of that. And nobody wants to be in the hot seat. No administration wants to be the cause of that because it's going to affect them when it comes down to elections again. I don't like to talk about politics in here, but that's real. That's real in what's going on as well. So I think that the Fed really has to stick to his guns, and he's got to keep inflation where it is. He's got to keep interest rates right where it is. But again, that's my opinion, and you're not here to listen to my opinion, but I'm going to show you some more information as well. What should the Fed do? Now, that's what the video is all about. What should the Fed do? Again, my opinion is to stick to the plan. I shouldn't have had that up there because that was my opinion. I'm just saying. Now, I think that the Fed is willing to overshoot rather than to fall short. They already came up short when they said it was transitory. I don't think they want to put themselves back in the same situation of saying, all right, we'll cut back. And if inflation doesn't get better, it's pulled off. But if it starts to rise again because the jobs market is strong and because people are still spending and all that kind of stuff, then what? I think he would rather overshoot than to fall short. The economy is hurting, but will it break? And that is a big question right there. Will the economy break? I don't know how many of you think that it will. I honestly think that we're resilient enough that we won't break. Well, there's another side of that. We can always keep printing money. That's another whole side, but that's another video for another time. He's walking the tightrope with strong jobs. You know, the Fed's job is to maintain price stability and maximum jobs, right? But if he's trying to shrink the economy and the job market is not cooperating, what does that make him do? Well, I got to get these jobs to a point where people are feeling the hurt. Layoffs are coming, though. There are going to be layoffs coming. But right now, strong jobs market is weighing heavy on his decision. Do you know that there's 11.4 million job offerings out there? Now, the problem is some of these are in the service industry. Some of these are more specialized jobs that there's not enough people out there to fill. But it's still a strong market. And if the market is strong and people are still willing to pay people to come to work, that still gives money into people's pockets or money into people's hands to spend, and that will still keep driving prices higher. Just think about that. But the economy is shrinking. You look at the housing market because of mortgage rates. You look at people not going out to buy new vehicles. Loans are affected. In order to borrow money, you're going to have to pay it back at a higher interest rate, making people back off from trying to even put in a loan for anything. So the economy is shrinking on that point. But when you look at the jobs market is not working in line with what the Fed is trying to do. On the other side of that, credit card debt is rising rapidly because the people are working in jobs and if they're not keeping up with inflation, what are they going to have to do? Spend on their credit cards. People are willing to buy now and pay later when it comes down to travel as well. Interesting. Another video for another time. Layoffs will be coming. And will this affect his decision? I think that once he sees that happen, then he may pull back because that will then put into a more complete sign of a shrinking economy. Now, with all of this being said, right, I'm going to show you the rest of the story. And now I'm going to open up into the VectorVest software. I'm going to take off a couple of things real quick. I'm going to take off ETI and 50-day moving average. All right, right here, here's the picture of a market climate graph. It's the 30,000-foot view of the market. Why is that important? Because it takes all of the noise out of the way and you see what's actually happening. As inflation rose, here's CPI, as inflation rose to a 40-year high, what did the Fed do? They were going actively after inflation, raising the interest rates. I'm going to use that at the T-bills to show the interest rates. Raising the interest rates, running. Has inflation topped? Yes. Have we hit 40-year highs? Yes. We have to both questions, all right? And with that being said, look at the pullback on inflation. Is that enough? Now, I do know that the raising of the interest rates is more of a laggard indicator. I understand that. So maybe a lot of people out there saying, let's step back a little bit and give the economy some room, or let's give that inflation number some room to pull back and see what's really happening. You would think that with the steep increase in in interest rates, that this would have pulled back a lot steeper as well. You would think that, but it hasn't. But I know that it takes, it takes every so often before this comes out, blah, 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 blah. All right, it has topped. It is getting better, but is it getting better enough? Now, let's talk about earnings, because earnings is the engine that drives a market higher. Let's look at the 50-day moving average on the earnings of the S&P 500, which is currently sitting at $9.21. Companies, for the most part, are reporting that they're meeting or exceeding earnings. They're doing buybacks. They're doing everything to pull people into buying into those companies, even during this time of high inflation. But there's something happening. Let's go look at the earnings trend indicator. We take the earnings number on the 50-day moving average of the earnings per share of the S&P 500. We put it on a scale between 0 and 2. Notice that the earnings trend indicator is trending lower. It is still above the value of 1 on our scaling between 0 and 2, so we are still in a bona fide bull market. We're still in a bear run, but we're still in a bona fide bull market. And until that indicator goes below the value of 1, that's when we will trigger a bear market, a bona fide bear market. So what do I think? I think that the pullback in inflation is not as steep enough, doesn't show enough for the Fed to really cut back on in interest rates. Earnings per share, companies are still, for the most part, meeting or exceeding their earnings expectations, but the rate of that earnings expectation is falling. $9.21 on the average stock in the S&P 500 is not half bad, especially in high inflation, but it is pulling back. So with all of that being said, folks, I laid out the story for you. What should the Fed do? You make your own decision. I've laid out the story to show you what's going on, what happened in the past, what did we do, and what's going on right now. Folks, this is that information where we actually do the work, you reap the rewards in having a better understanding of what's going on in the market. Why is that important? Because that helps you to make better decisions in the stocks that you buy and sell and how you manage your portfolios. So again, share this, hit the like button, all those things. My job was to just give you the information, not just the data and the noise. Folks, this video is over. And until the next time, see ya. Hey VV Nation, Glenn Tompkins here from VectorVest, and I've got a great announcement for you. Right now, we're getting ready to start a free 28-day portfolio cleanup and setup challenge. What does that mean for you? We're going to show you how to get rid of the stocks that have been hurting your portfolios financially and emotionally. We're going to show you how to pick some really good stocks to buy and to know when to buy them. Big thing here, manage your portfolio each day with complete confidence. Folks, don't put this off any longer. Join the challenge. It's free. Go to www.vectorvest.com/28.